Good afternoon, everybody, and welcome back for the 6th Annual Energy Storage Summit. So we are on to our final workshop of the day. So this workshop will be hosted by James Law, Senior Manager of Local Energy Markets, and Fabrizio Fenu, the Flexibility Solutions Manager at EDF. So the kind of aim of the session is to be as interactive as possible. So everybody who is in the session, it is optional, but we would like you to try and turn on your cameras and mics, and we can try and make it as dynamic as possible. So we'll do that when we get to the discussion part of the session. And until then, I will hand over to Fabrizio, who will be sharing his slides. And I believe we also have a poll running, so look out for that. And I hope you enjoy the session. Over to you, Fabrizio.
Thank you. Well, hi everyone. Just a brief introduction. I'm Fabrizio Fenu. I work for EDF Energy as a Flexibility Solution Manager. I work with the group in Italy, Russia, and UK, always with business development position related. And I have the pleasure to work with the majority of you daily, ensuring that you get all the support you need from EDF.
My name's James Law. I work in the Energy Trading Services team at EDF Energy, reporting into Stuart Fenner, who some of you may have seen his presentation yesterday. He's recently taken over from Chris Regan. Chris, if you've not met him, you've almost certainly heard of him. My role in EDF is, at this point in time, is making sure that the shift team have the tools they need to be able to optimise flexible assets to make as much money from them as possible. Make sure that we can, and that we're continually updating those tools to meet any new and exciting warranty constraints you may have for us.
Thanks, James. So as Lucy said, the aim of the session is really to try to have a workshop all together to discuss what should be the route to market in your view. What is the route to market of your dream? This is what we would like to be able to shape at the end of this question. So really, please, let's keep it as dynamic as possible. Intervene, giving us your view, because otherwise we continue to think in isolation about what could be important for you. Instead, we need to have this steering from your side. We just set the context with the first two slides, and then we open the session for the debate. So very quickly, how we have seen the market changing in the last 12-16 months. End of 2018, probably not considering the owner of asset allocated to EFR market, there were probably just above 5 owners in UK of battery storages. We reckon that end of 2021, the number should be about between 20 and 25. Of course, it also we have also seen the number of the route to market provider improving and increasing in the last months. We have seen the asset owner changing from what you were 2 years ago and what you are today. You have a much higher knowledge of all what these systems are, how the system work, what are the revenues, what is the regulation of behind each product. Your team are getting bigger. You are hiring people with coming from different experiences, from manufacturer, from EPC, some from route to markets. We see people with asset management background on your side, so you are becoming always more demanding and more technical in your request. We've seen the negotiation as evolved with this change on your side. So we've seen, for example, many tender being issued more than bilateral conversation as it was in the past. We have seen performance fee deal or tier structure. We have seen different clients with different appetite for different structure in terms of remuneration for the route to market. Someone would like to have the tier, someone not. Someone would like to apply different fee to the different services. Someone has then moved back from that position, coming back to one fee applied to all the structure. So it has been a quite dynamic scenario. We have seen, we've been discussing a lot of long-term deal, and we think that the focus for you is mainly on de-risking the project, eventually with floor or working on the assumption behind the degradation, on trying to negotiate on the liability part. In terms of the conversation have evolved in the same context. So we've seen that actually the banks and the investor are asking to involve the route to market at earlier stage in that conversation, and sometimes in the conversation between you and them as well. We've seen that you require a more consultancy approach from our side, especially for what concerned the regulation, for example, of this project. We've seen a lot of conversation about warranty and new services, especially in the last 6 months, I would say. And sometimes you have asked us to play a bit of a role in between the route to market and the asset management. This is what we have seen from our side, and this is to set the part of the conversation. We have seen also the revenue changing and evolving substantially, right, James, last year?
Yep, certainly. The revenue's gone up quite a bit last year, which has been really good. A lot of it thanks to dynamic containment coming along, and also the impact that that's then had on FFR prices, which seem to be sustaining nicely. And
how did you see changing the role of the route to market in your view? And then we expand.
Yep. So I think it was this purpose of this slide is to get conversation going a bit, and this is my view. So I guess my perspective is slightly different because I'm the side of the optimizer. I've stolen some of the charts from Stuart's presentation from yesterday, but I think things started for us really simply in 2019. I think I started on the project, it must have been about 2018, with a view that everything was moving to wholesale, and that's what we were getting ready for. That's where our expertise was. We had a 24/7 shift desk, and we do really well in the wholesale markets. And that's not just a belief from then, that's a belief from now as well. But then as we moved into last year, we had weekly FFR come along, slightly more complicated decision process because we weren't just thinking about monthly FFR. And we were actually doing last year, we were probably back end of 2019, much of 2020, we were actually doing some wholesale as well. It's really great to be able to show what you can do and to be able to show numbers to customers. And then October last year, everything changed again. National Grid introduced dynamic containment, and it felt like the role of the optimizer or the route to market provider had changed from somebody who was going to be sat there doing responsible for hopefully making lots of value for you out wholesale, to somebody who was either having a bit of a stab trying to get as much as you could out of FFR, but ideally for dynamic containment, the route to market provider was broadly typing 17 into a spreadsheet into a system each day or once a week and just leaving it there. That it didn't actually get it didn't get more complicated, it got simpler. I think that's where we are largely at the start of this year as well. So National Grid have introduced stacking. It makes things a little bit more complicated, but not hugely so. It's not an opportunity for us to add loads of money. It's an opportunity to minimize the cost of state of charge management for dynamic containment. But I think The one thing that we do know going forward, and whether it's towards the end of this year or some point in the first half of next year, is that the ancillary services will start getting saturated. We'll have a couple more come along, but they will get saturated. And at that point, whereas we'd started a project thinking we're going to be having our shift team optimizing batteries in the wholesale market, it's not just going to be wholesale. It's what's the best combination of services to stack. Do we like the idea of some security when it's still there, of monthly FFR and certainty that brings? Dynamic containment isn't going to be £17, it's going to fall from that. Every asset's therefore going to have a different exit price based on our view of how much money we think we're going to be making from wholesale the following day, for example. So we've gone from a world of trading in the markets that we're used to knowing that in the very, very near future, it's going to be a lot more complicated than it was a couple of years ago. So I think that's from the view of a asset optimizer. I think that's how I've seen things change, and what I think is going to be happening this year, possibly first half of next year as the markets get saturated. But it'll certainly be interesting to hear other people's views on what we've learned about the role of the route to market provider over the past year.
Thanks, James. So here is where we would like to really see your view from the people around this virtual table about how have you seen changing the role of the route to market in the last 12, 16 months? Don't ask us to break the ice and pick up one by name, but who is the bravest?
Hi Fabrizio, it's Ned Punsonby from Zenobi. I think in the last 12 months, broadly speaking, the people who have outperformed are the people who have picked the revenue streams in the best possible way. There's been very little outperformance based on say the performance of a shift team as opposed to when to use your shift team. So it's clear based on the last year that in order to the people that are outperforming currently are the people who have managed to get into the DC market faster than say their competitors have. It's at the moment it's not the case that the outperformance is related to say the quality of a shift team, but effectively stock picking.
Yeah. Thanks, Ned. Interesting.
Yeah, I would. Hi, it's Alicia Kowalska-Montfort, Ghost Street Capital. Yeah, I would kind of definitely confirm and just almost reinforce what Ned said. I think for us, it was very clear that some route to markets were ahead of the game and they thought about DC ahead of time. So they had technical solutions that, you know, sort of allowed them to come to site and be pretty much almost asset agnostic. They were, you know, they were able to come to site, be independent from the metering potentially that is on site, and be fairly also independent from the restrictions of the asset. Of course, the asset has to respond within, you know, the timescales of DC, and it has to have the right accuracy, etc. But even with the certain sort of restrictions that some assets put on response, you know, those route to markets were able to work around those restrictions as if they kind of, you know, predicted what the suite of restrictions could be, and they had a solution for each one of them. So that was a real differentiator. And of course, it's only for one specific service, dynamic containment. It doesn't have to be that way in the future, because perhaps future services will be less demanding, and that role, that technical excellence, will play a secondary role. But you know, seeing how probably we're moving into faster ancillary services, more demanding ones, like, you know, looking at DS3 markets in Ireland, that technical excellence will play a role. And then I guess the second leg of what we would be looking to route to market guys would be to have this kind of proactive relationship with National Grid, perhaps working with National Grid to shape some of the revenue streams to allow batteries to access new services like reserve in BM, etc. So I think that's really helpful to know that people are pushing the boundaries there, and I guess that's another point.
Yeah, definitely. Thanks. You hit a lot of good points, and then we comment together. But anyone else that wants to add any view?
Xavier Cleary here from GAG. Actually, I wanted to say, I'm not sure I agree entirely with the previous comments. I think in terms of performances, I'm not sure on what sort of benchmark we're all using right now, but I think there's definitely some value that is probably less transparent to, I guess, the market entirely. And unfortunately, it's probably the value that we are talking about here, that where go-to-market providers can bring a lot more expertise, I guess, to the table on the wholesale, and particularly, I guess, in the recent events. I'm just wondering, for these lucky few who actually were able to jump in and out of DC, I'm pretty sure, without a doubt, that there was a higher, I guess, revenues to be made than just solely staying comfortable in DC, in my view. But I don't know, EDF, what's your view?
Yeah, I mean, I can maybe comment just from course. You said, yeah, I fully agree with you, Xavier, that there are opportunities to jump in and out, but whether you will build a solid business case in the next year on them, I think you have to be opportunistic to jump on them when they appear, but to build your financial model on that basis is you would have to be very bullish. But yeah, on a sort of day-to-day optimization, I agree that there are more opportunities coming from other markets, BM and others. So DC is not always going to be the answer, but it's the baseline, right? And it's a strong baseline.
And would you have expected that this was supposed to be what the route to market had to deliver 12 months ago?
Yes, Fabrizio, I think we would. I think the difference between now and a year ago is that today we are able to jump from DC and then look at the day ahead forecasts and say there's £1,000 spread there.
Yeah.
We expect that to be captured.
Yeah.
But I don't think that necessarily, I would call that stock picking. I wouldn't necessarily say that is a particularly complicated part of wholesale optimization. But yes, we certainly, as someone that's looking for a route to market provider, would look to ensure that they consider on a day by day, hour by hour basis what services it should be providing.
I think that's very much hitting the nail on the head over the last year. Is that the move of ancillary service tendering from being something which was previously month ahead or then a very small amount of week ahead to something which is now being procured on the same time horizons as the day ahead auction. I mean, we've got the results of one of the day ahead auctions before we're tendering for dynamic containment. So there's a huge amount of information which can support the DC tendering, and it's how that's going to progress over the course of this year as well, because National Grid's plan obviously isn't that it's going to stay as a day ahead service. It's going to, whether it's ether block, whether it's half hourly, it's going to change, and it's going to become a lot more complicated and involved picking what to do at which times of day.
Yeah. Before I try to summarize the various concepts, any other view on these, how has changed the role?
Hi everyone, it's Jamie Dunn from Ilpower here. I guess stepping back a little bit, it's all these new revenue streams Fabrizio have allowed sort of route to markets to provide a sort of floor offer now to the market. That's sort of the big change I've seen in 2020 as well, which is, you know, it's obviously managed to unlock quite a lot of fundraising capital. You know, it might not be anything we like to particularly do from an operational perspective, because, you know, I know we keep money on the table to do that, but you know, it's very important to the actual fundraising process.
Thanks, Jamie. Then I would, because we have actually started asking also what should be the view of the route to market in general. So let's retake that in a second. And we wanted to explore with you one other topic. What are the main barriers for you to get your project approved? And we have some, we have a poll, we have some possible answer for these with the support of Lucy, I think.
Yes, I've just started the poll, so it will be live and that will be on the portal. So you should be able to vote now. We'll just wait a few moments for the votes to come in. Great, so I'll share the results with you once they're through.
Then meanwhile, I try to I start recapping a bit the various topics touched by you on the line. So the first thing is you have appreciated the route to market having a faster reaction in adopting the new scheme. There is actually a premium, there has been a premium in the timing of adopting the new scheme. You also stress the proactivity, not waiting that the scheme is live, but working already in advance before the scheme is live to be ready when the eventual new service will be live and delivering. And this is where you also touch something that for the concept that there was like probably 16 months ago, it was in the middle between the route to market and the asset management about coming on site and eventually making the site ready for that. It's not something that probably was necessary in every route to market scope of work, but it's definitely playing a role, and probably in the future there is a possibility to play a role even bigger in that sphere. Proactivity in the relation with national grid, not only to push for new product, but also to shape this new product, to ensure that we work cooperatively with grid. End of the day, we are all providing a service that is necessary to grid to this structure. So it's important you highlight the role of the route to market in working together with grid to ensuring that there are revenues that fits for batteries in providing that service. Jamie has touched a point about the floor and about the fact that having the possibility of all these new revenue streams can also provide more certainty on the route to market, so that the route to market can feel more confident in providing floor and can make easier for you the financial conversation with investor or eventually banks. Of course, we have also mentioned the possibility of stacking and providing the service across all the route to market simultaneously, I would say, touching the point from Xavier. Have I missed something from the conversation? Do you want to add something to this picture? He's trying to take quite a shape, I think. But okay, do we have the result from the poll?
Yeah, absolutely. So the vast majority are concerned about the uncertainty of revenue. So that was 64% of the vote. And then 18% was around the expected IRR not being high enough. And then there was a little bit of uncertainty over technology, and then we had 9% voting other. So I guess it would be interesting to find out what the other barriers might be.
Yeah. Anyone who wants to expand a bit on these difficulties and what could have been the others?
Hi, Fabrizio. It's Hugh Kennedy here from Shanghai Electric.
Hi, Hugh.
I think for me, the first 2 points are really the same thing. If you're not certain what your revenue is, you're not quite sure whether your IRR is going to be high enough. So they really are very strongly linked. And I think for us, it's getting a clear picture from the optimiser of what we can expect, not just in the next year, but also in the long term in terms of revenue, because that's the key input to the model.
Thank you. Yeah.
I can tell what I voted for. I expected IRR was by choice. The uncertainty of revenue is, in a way, for me, an inherent direction of travel where we're going to, because the certainty of revenues was really, was really you could have that when we had EFR contracts or a multi-month FFR contracts. That's where the certainty was coming in place. I guess the uncertainty now, and that sort of translates itself to the IRR, is really the uncertainty of the fact that we don't know where DC is going to get suppressed and to what levels, and whether it's going to converge with FFR or is it always going to be a little bit more, higher revenue stream. So that's the uncertainty, perhaps, you could talk about, but I think we all know that we will not have a long-term contracts in this space, or at least they will be very specialized and localized. So in a way, perhaps that's the differentiation that we learned in UK to operate in a very merchant aggressive basis. So I think in a way that's the positive thing, that we managed to build batteries on that basis. But the uncertainty really comes from oversupply of batteries rather than the fact that we don't have long-term contracts, because we know that for some time now.
Thanks, Alicia.
Yeah, and I actually Xavier here from JJ. I would probably I also can say that it was probably the same response that I gave. I think the uncertainty of revenue, I guess the market needs to be aware that it's a more long-term game, and I think in my view, if you get comfortable with the fact that the worst case scenario is inherently the opportunity cost to basically participate in the wholesale market, and intrinsic and extrinsic value actually capture, and that's probably where DC and FFR value should probably converge at some point. You're still in a world of from an investment perspective, in a world of merchant, which is a different merchant, I guess, risk than renewables. It's not directionally exposed to merchant risk. You're still in spread and time spreads most of the time. So if you take that assumption, I guess people are still investing money into renewable projects, and they are, I guess, intrinsically more risky than batteries actually overall, in my view. So the biggest risk really is actually the development of, I guess, another supply of a battery project on the market, I think, as opposed to the merchant risk and the certainty of revenue.
Thanks, Xavier. Yeah, interesting.
I think it's definitely interesting talking about prices converging as well, because it feels like once the market becomes saturated and we've got enough batteries that can deliver dynamic containment, the price will start coming. Well, inevitably the price will start coming down. It's just how low it gets, because I think at the moment National Grid, I think I've heard them describe the cap price as paying a premium price for a premium service, but once it becomes competitive is whether people will be looking at that saying, we're doing 0.2 cycles a day with DC rather than a cycle a day throughput with FFR. Actually, because there's enough assets competing for that service, does the price of DC actually fall below that of FFR and potentially below wholesale as well, where you're doing 3+ cycles a day? So it's, yeah, uncertainty of revenue certainly feels like a thing. I guess from my point of view, the thing that stands out there is 0%. There's lots of people ready to invest in this market, which I guess is absolutely fantastic. I guess in terms of uncertainty of revenue, so we've got, I mean, EDF obviously offers a floor, but we know that other people are doing that as well. Is there any view on preferences to floor types? Because I guess we've got the floor offering that we have is very much more of a traditional floor, rather than a tolling agreement, which says, for example, we'll pay you more than the floor price, but any upside we keep. Whereas with a traditional floor, the upside, any upside is yours. Is there demand for that sort of a structure from a finance point of view? So we're able to, so revenue certainty can be provided at a higher level, but obviously the upside, should things move favorably, doesn't then get passed through, or is the current, I guess there's a number of companies offering floor prices, and is that current floor structure actually working?
I think if there was a price, you'd find that it's very similar to the price that we expect after the floor.
Mm-hmm.
So it would be a high price for the tolling agreement.
Okay.
I mean, I think from our side, we couldn't see value in the floor price because it doesn't give you an IRR that you can do anything with. So it doesn't really work. The advantage of the tolling agreement would be that you could probably bet the finance of the project on that tolling agreement. The only downside is it lessens your flexibility when you exiting at some later point. But I think that, around that, then you can certainly start looking at reasonable debt leverage, which with the current floor price you can't.
Mm-hmm. And is there anyone? Sorry, you go, Ned.
Sorry, I think I do have concerns if the entire market ends up on floor prices, whether or not, given the treatments of your customers within your portfolio, whether or not the sort of asset owners will have the ability to avoid conflict of interest in terms of bidding with other participants within your portfolio, within your sort of supply portfolio. Because if it's the case that you're deciding the bidding prices in order to underpin any kind of floor or tolling arrangement, that eventually, if everyone was on floors, then it would be difficult for asset owners to have kind of decision making in order to outcompete because of that floor.
That probably would go to budgets of Downing. That probably will be reversed if they do a lot of tolling agreements.
But in reality, this touch the management of there are two different ways. Assume for a second, because otherwise we enter in a conversation that will take quite a long time now. Assume for a second that by policy and by our regulation, that for how the system is structured, that there is not the conflict of interest in the way we manage the portfolio. Would you as an owner, would you prefer to have a certain amount of revenue granted, maybe higher than what the current floor are, but then renounce on everything above a certain threshold? Or would you prefer to have let's put some number to have the conversation. So we are in a 1C kind of batteries. There are floor between 20 and 30,000 pounds per megawatt. with a certain fee associated with, or there could be floor with, I don't know, like, imagine like 45, I don't know, I say something probably stupid, with a huge cut on top of that from EDF, or from a route to market in general. What would be your thing?
You mean the color?
Yeah.
Cap in the floor.
Mm-hmm.
Yeah, I think actually that's something we would probably entertain. If the floor becomes substantially higher and your fees in between the color are not too aggressive.
I guess that at that stage, everything on top, usually for what we have seen as possibility of structuring, the biggest cut on everything on top would be on the route to market provider. They will have a bigger cut on everything on top of a higher floor.
So a higher fee, but essentially, sorry, a higher floor. You're saying, Fabrizio, but essentially a much higher fee above that floor.
Yeah.
I mean, isn't that effectively just a tiering structure with extremely high fees at the top?
Yeah, but there is a much higher guarantee.
True. Depends where you think the market out.
At the moment, we didn't find it. This back is from what we have seen. We didn't see a lot of requests for that. We have seen more like a standard conversation about floors. Eventually vary on the duration and try to keep reasonably low the share on the route to market. Probably we guess that to support your conversation about the investment, but we didn't see yet the desire on your side to have a much bigger flow, but giving up on everything on top of that, for example.
I think much higher floors haven't really been on offer up until now. Obviously, as I said, if you've got a much higher floor, then you can go to the bank and you can start talking about, leverage of, I don't know, maybe 60% or something, maybe one day even 70%. Then you can start having those conversations, and then you have a whole different structure to your project, and probably different types of investors where, the certainty of return becomes more important than the possible upside. Yeah. And you can start to talk about that. At the moment, I think you have to believe in battery revenues, and the banks will back you, but only to a very small extent. But if you had a much higher floor, then you could start talking about other institutional investors who are perhaps less adventurous than the ones who are currently in the market.
Yeah, probably. Yeah, it will be always a tricky conversation in finding that sweet point between the higher floor and how much of the revenue the investor is ready to give up on that.
Yeah, I think it needs to be at a level that will cover a high level of gearing, basically, because gearing only really starts to make a big difference to your project, probably above 50% or so. So it needs to support at least that level and probably more.
Yeah. Interesting. Anyone that had issue in getting the project approved because of question on the technical aspect of this project, because of question on the technical aspect of the battery itself?
I think it's fair to say that everyone's warranties are fairly unique to them. We have to model the returns based around the warranties that we receive.
Okay, and that is sufficient for giving enough confidence on that?
Well, we receive questions, but we answer them.
How flexible do you find the battery providers to be with their warranties and the conditions there?
We can do markedly more cycles than we could in the past. Yep. We're no longer talking about 1 cycle a day. That opens the sort of current, most of the batteries connected to the grid at the moment are sort of doing between 1 and 2 cycles. I think it's fair to say that will not be the case in a year or two's time.
Yeah, agreed.
I think flexibility of the warranty is obviously going to be key because, as you said previously, the markets are going to be changing, or the way the batteries are traded is going to be changing, day to day. So yeah, you really need a flexible warranty which accounts for the way the battery is operated and cycled, not just for fixed numbers.
Yeah.
I guess.
Go, please.
Yeah, no, just to comment that generally, I guess the positive side is that you don't see, at least we don't see, providers who are proposing non-flexible warranties. So perhaps there's the suite of providers we work with, but it's kind of became, I would say, the standard now that the warranties have to be adjustable. Otherwise, it just doesn't work. No one has the visibility of the future revenue streams to the extent that you can fix your degradation line. So you need flexibility there. So I think that is, at least for me, this is a given. Now we should improve on it. I guess that's the point, because there's still, in my view, not enough transparency between manufacturers and us in terms of the real degradation. So you just have to have your own operational data and work it out from your own, try to work out the actual impact of various parameters on the degradation. And that's tricky because that's empirical data, and it's difficult sometimes to decouple effect of temperature or throughput or other parameters, well, depending on the chemistry of the battery. So I would say that the knowledge of this sort of parametric impact on degradation it's a huge value, but it's difficult to obtain from manufacturers.
And was it you, James, or Ned? I don't see. Sorry, I wanted to ask you, do you get enough support, or do you need support from the route to market in that conversation?
Yeah, for sure, because you guys have the data. You operate more batteries than most owners. So
are you getting enough of that?
In general, or you mean from the
in general, like from the route to market? Do you get all the support you need, like, or you may want, I don't know, modeling for warranty? It would be better if it was done in a certain way more than another.
I think generally kind of sharing that data with us and that knowledge would be hugely beneficial. So yeah, I would say more of that would be definitely beneficial.
Fabrizio, I would just add as well is that route to markets can really help out if they sort of share with us how they forecast the sort of use case profile is going to be. So, if we sort of look 2 or 3 years into the future and you imagine what these batteries might do, and then we feed that back to our manufacturers now and just ensure our warranties cover those use cases. So it's always sort of talking about, what are these batteries going to be doing in 4 to 5 years? And can we make sure we build them to be capable of doing that as well?
Yeah. Okay. Please add another very good point. Yeah.
And Fabrizio, it's Andrew McAlevey from Pencil Power here.
Hello.
I think it's also important to remember that at the initiation of these projects, we're signing up to often very long-term agreements with battery providers around warranties, long-term agreements with access to market off-takers. And, we try and make those as flexible as possible, which is the right thing to do. And I would agree with the comments earlier that battery providers are getting more and more commercial and providing more flexible warranties. In terms of maximizing the flexibility, I think it's important that you manage your procurement process well, because ultimately it's a commercial discussion with these battery manufacturers. But it's certainly something that can be managed. the additional point I would make is we need to realize that we're on a long-term journey here, and there are things that we will find out in years 2, 3, 4, 5 that we need to work together to address and solve. And so there's often information you will have as an off-taker that we can work with our battery providers to try and optimize the overall outcome from an investor perspective. So, for example, charging at different voltages, or different usage patterns based on temperature. So there's things that I think we can work together to try and optimize the outcome from an investor perspective.
Thanks. So I think we had then this question for closing, but I think we have probably touched at a different point during the conversation. So do you have clear what are your expectations from your route to market provider? Appreciating that part of these came are already out during this the conversation, but something you want to add or to stress in particular on this point?
So I guess we've talked already about being ahead of the game, proactive with National Grid, pushing examples there of the reserve trials last year, dynamic containment, looking to push boundaries.
Yeah. Cooperatively working for the warranty and forecasting the degradation.
Mm-hmm. I think one of the things that's quite clear is that getting that optionality to jump in and out of different markets, a lot of that is software based. And so without a really strong software team being able to access certain markets in certain ways, and potentially signing up to obligations placed on people in order to access those markets is really important. Yeah. It's not simple to put. Put it.
Probably in the next month will be not immediately, but like next winter and on, it will be absolutely crucial. Because now we have seen a couple of days of that opportunities, especially in the early days of January. But forget about when the issue was related to some plant tripping. For the rest, we didn't see that happening again in terms of possibility on the market in the last weeks, for example. But in the future, it will be absolutely important, especially with the services, as also James was commenting about, having them fixed per IFA block or half hour. It would be absolutely crucial to have that possibility.
It definitely feels you're right on the IT side of things, though, Ned, because it's this whole forecasting DC prices, for example, but the outcome is going to be different depending on whether you put the assets you're controlling into that process or not. So we saw that last summer with FFR switching assets into static, and for the weekly auction, and with the benefit of hindsight, it might look like the wrong decision. But if you've put an extra 40 megawatts into a market that's only 100 megawatts deep, the price in the dynamic would have tanked massively. So it certainly is very, we couldn't agree more from the software point of view.
I would add that I'm looking for a route to market in the next couple of years as well to manage how best to phrase this, sort of site-specific battery conditions. In a couple of years, we're going to have batteries which are getting up to 5 years old. They're derated, they'll have site-specific issues. We're going to be cycling batteries harder, which can cause derating issues. So it's gearing up route to markets to be ready for that and to dispatch appropriately on site-specific conditions. For the past 2 to 3 years, we've all been doing FFR and DC. These things do not stress batteries out. So, you know, what worries me is we go into the future and, you know, we're going to be stressing these batteries out, and it's working with the right partners to dispatch them in appropriate ways that don't cause deracing or don't cause you suddenly to have a massive imbalance or to become unavailable.
Yeah. It's a very good point. We can then pick up separately. There was some work done by James and the team last summer, in particular on one of the aspects. This is something that we can pick up beside, but definitely it's an important point. Yeah. Great. Do you anyone that who wants to add other concept to this conversation?
Yeah, actually, just as the previous point, there's one point that has been kind of, so I'd be interested, kind of, maybe it's a question to you, Fabrizio, just throwing it back the session, reversing it a bit. So when we saw dynamic containment kind of approaching, and there were kind of, you could see that various route to markets had a different approach for the technical solution. It also became very clear that, you know, depending on your site and your technology, you had sort of different parameters that potentially route to market will have to access. Like, for example, either potentially trying to slow down some of the assets because some of them were too fast. So you had to find ways talking through, you know, Modbus to the battery to slow the asset down, or try to figure out to speed it up. You had metering issues, some EMSs and some batteries, you know, were potentially struggling with the rate of the metering data collection that DC requires. How do you guys think about this in the future? So you will be inheriting various batteries and various technologies, and there will be new revenue streams that potentially will require you to have a relatively big control over the, you know, the EMS of the battery. Generally, those batteries are kind of a little bit of black boxes, right? You get a Modbus control, you can send PQ set points, but that's kind of, I think that's maybe where the limit of your control comes in. So do you have a view about how you're going to be ensuring in the future that you can come to site and you don't suddenly discover that now you have to go back to, I don't know, whoever that is, you know, the Varzilas and others and BYDs to tweak the system, and now you're, you know, 6 months into this project and you're still not achieving the result that you need? Is that something you guys have thought about and have it on your radar, potentially, that you know, readiness for tweaking the assets to more demanding responses? It's probably less for, it's more ancillary services, right?
But no, I think there is in general, and it's very well fit in understanding what the role are, because you would have expected, if you think about things like the FFR, for example, you would have get the asset, then you set your control, you set the gateway box, you set everything, and then it was practically ready to go. And usually there were a bit of cooperation necessary between the asset owner and the route to market, and sometimes the asset manager, to make sure that everything works. So there are scenarios where the asset owner and the asset manager are actually practically or the same person or very integrated, or other situation where the asset manager is practically integrated with the route to market. I think that in that situation is where the setting goes more fluid. When you have the picture split among many different partners, is where probably it becomes a bit more difficult to follow the management of the process.
Agree.
But it is so coming back to the question, is definitely something that we are thinking, because we have seen, like with some asset we have worked, we have put them on this immediately, but it was again, it was where there was the possibility to do it. In some other, we are working to support that part of the change. And in some case, it has required a bit of change on our side in terms of mindset, because again, we were pushing ourselves a bit out of what was the role as conceived initially. But I think it's crucial now, and it will be even more in the future, Alicia. So definitely, it's something that we have under we are working on that. I think we hope that you see it quite often in these weeks working with the team.
Yeah, no, thanks. You face, but I'm smiling positively.
Thank you. Yeah, but it's a great point. The way of managing the different role in each project is something that is very crucial for the timing. That is the thing that you all have touched initially. The first thing you said was the timing for entering in the new product, because it's true. It's a long-term project. You have 15 years or more of life of the batteries. But you all manager are probably targeted by your companies on the results providing. So we understand that, and we are in the same place. Okay, I don't know, Lucy, can we continue, or how is for you?
I'm happy to continue for 5 minutes or so, if everyone else is.
Okay, because I thought we have overrun. Sorry. Okay, then these cover quite a lot. I have the feeling that we have covered it.
Is it worth summarizing what you've noted down, Fabrizio? Well, in terms of the requirements or expectations.
Yeah. Well, but more in terms of requirement expectation, we said very fast reaction on all the new products, proactively on the new products, being ready when the new products kicks in, not after that the product has kicked in. Stress the potential requirement of enlarging the scope of work, covering part of the asset manager, or anyway coordinating that smoothly. Stacking, managing the stacking on the day-by-day base and intraday. Proactively working with National Grid, shaping the revenue with National Grid. So making sure that the revenue are fit for the batteries. We have expanded quite a lot about the floor and about the two eventual system of the floor. We have touched about a question that there is a general question that is always, I think it's in general for the route to market. And we will provide the one of you who need it, all the support about it, about the potential conflict of interest, because many of you mentioned that. View of the future, view of the revenues for the future, management of the asset, taking into account how the assets are already affected by degradation after years. Sharing on the warranty and utilization of the batteries in order to support more the conversation with the manufacturer. Help me, all the role of the software and the optionality. And I think this is all what I have managed to capture. It's quite a
long list.
Yeah, but it's, well, I think that in one way or the other is what was coming from all the conversation we heard in the market in these months. And thank you all really for sharing these and for participating to this conversation all together. It's a bit of an experiment, and probably is really helpful for imagining what should be the route to market shape in the future.
Great. Do we want to leave it there? And of course, everyone can have access, well, everyone on the call has access to the recording. So you'll be able to download that from the portal if you want to go over it again. And of course, I'm sure Fabrizio and James will be happy for you to reach out with any other questions.
Yep, definitely.
Great. Okay. Well, thank you very much for hosting the session, Fabrizio and James, and thanks to everybody for getting involved in the conversation.
Thank you, really.
Thank you very much.
Thank you very much. Goodbye,
Cheers.
everybody.
Bye-bye.
Bye.